Of course, I always like to start off the week with a summary of what I saw happening with the stock market and for the week. And really, it was a decent week so far. Looks like we're finally going to have an up week. We've had 3 down weeks in
It's
a
been a
row.
bumpy one.
Yeah, and we've been talking about, actually right near the top there, we started talking about the fact that we felt the market was going to need some type of a pullback, a consolidation period, rest. Because we had such a giant run from, really the early part of May.
Mhm.
Ironically, when Silicon Valley Bank went out of business, that was the beginning of the run. Not what you'd expect, right? And it is one of the key things to think about. I'll bring this up again. Understand the power of what the government can do, right? In how that might affect the stock market. So when Lehman Brothers was allowed to fail in 2008, the stock market dropped 30%, after that. And this time, instead of allowing the banks to, fail and depositors to lose money, which would have caused probably another Lehman event, government stood up and said, hey, we're going to backstop the depositors, and all of these different programs are put into place. So very important to understand. It sort of fits in with, a lot of talk over the last couple of weeks since we did our last show about China, right? And so it kind of fits in that same category. And so today, China came out with some more stimulus programs and reduction of transaction costs on stocks and those types of things. And it's still probably not enough. They've got some issues, but they're the second largest economy. At this point in time, we have to assume that they could do enough at some point in time. And so again, that's why I tend to discount some of those things a little bit. The biggest thing I really want to bring home today has to do with the fact that if you're hearing something, and it's lots of articles are out there and what have you, the stock market has already factored that in. And oftentimes the market goes the opposite direction when that actual thing happens. So for example, this week we had earnings from NVIDIA, and boy, there was so much talk about the earnings and how great they could be. Markets going up, NVIDIA stock went up even on Monday before the announcement. And because the last time that they had an announcement for the first quarter was spectacular, it caught the market by surprise. I think NVIDIA went up roughly 40% in a few day period there. This time, nothing, right? Even though the earnings were spectacular. Again, everybody's expecting something to happen and the market to jump and NVIDIA to jump. It's not going to happen. That's a saying that you can say to yourself. If I'm reading about this and it's the debt ceiling situation was something we were getting a lot of questions about. It turned out to be, a scary scenario, but the market, I think, had a high and low drop of about 3%, which is actually more than it's dropped even now in this particular downturn, about 5%. So I think those are some core components of investing that we need to understand, and maybe thinking about it the other way. What are we not talking about? I remember very, very little was said about credit default swaps in the 2008 downturn, and they turned out to be the news, right? And the surprise. And so those are the types of things actually that I tend to focus on even more, those one-off articles like I remember in 2008 about credit default swaps, which were, for those of you who don't know, were insurance policies that were issued on bonds that were made up of mortgages, right? And they were selling them like hotcakes. Apparently they sold like $7 trillion worth of these in a very quick period of time, thinking there's no way that these bonds with 1,000 mortgages and it could default. Well, unfortunately they did, and the mortgages that these bonds had to pay off, these insurance policies had to pay off, and et cetera. And then Lehman was one of the pieces of that and the house of cards that fell. And so these are things that, that are out there that we don't know about. We're all talking about China, right?
Yep.
And the market's factoring that in. Now, sometimes I'm wrong in what I'm talking about, and it happens, and, China falls apart, and, but we were all talking about, the Ukraine situation being a big disaster for the stock market. It didn't tend to be. We all said that the oil and gas, lots of articles about how high that was going to go, maybe 200, 260 a barrel. It actually went down. It's coming back now a bit, but it really, things tend to go the opposite direction of what you're hearing about the most. That's the point. And man, 9 out of 10 times, as far as that goes. So here we are. We're having this consolidation period, and again, I've got some, some lines drawn in here, kind of where you might see some motion. and we're in this range, and really what I'm looking at when I see something like this is this a consolidation period, or is it the beginning of a full-on downturn? And one of the reasons you have to kind of let things run for a while is because of that. Because look, I think that if I look at kind of what I'm really concerned with are these resistance levels right here. So see that first green line, that actually is the top for last summer, August 16th of last summer. It took us a bit to get through that and what have you. I would be somewhat concerned if we broke through that. Not wildly concerned. I'd actually be more concerned with that second line there. If you go back, 39.50 on the S&P 500 was a really heavy period of time that a lot was purchased at that level. You can see some good support and resistance at that level. And so, the thought process with resistance is that it gets down to that price. So it gets back down to 39.50. And those stocks that people made money on, in the last few months, I got back down there, I'm going to buy some, right? And so they buy, and usually you get that bounce, and then it comes back up. But if they don't buy enough and it falls through, then it becomes, it goes from support. I've been using the wrong word, from support to resistance. And so that's the kind of the key piece here. We're just going sideways until you start to break into new lows that are lower than previous lows. Because, we have an intact upward trend right now. Primary trend is up. Each one of these highs is higher than the previous high. That's important. And each one of these lows is higher than the previous low, right? So that's intact. We break below that 39.50, you can make an argument that we no longer have an intact, primary upward trend. And there's still a bunch of people predicting that we're going to have these big downturns. These are the same people that were predicting the giant recession in the first half of this year and all those things too. And again, I think that classical Wall Street view is that we should be falling. Yeah. Yep. And because we've raised rates so much, but that's not really happening. Let's talk about the signals, because we had some changes today in the signals. So first of all, the stock signal went to green today, actually on the fast signal, still yellow on the slow. And so we have two different systems that we use. When the stock market is moving upward, and we define that as the 50-day moving average is above the 200-day moving average, then we are basically just holding on to the positions we have until they fall below a certain level on our list. So we got a list of 175 ETFs in our universe, and we optimize where that cutoff is. Right now it's top 55, right? And so when it gets below the 55th, 56th, we might sell it and buy something at the top, right? And so we've been buy and hold for quite a while here on our targets. We haven't had anything really fall out. Mostly it's been technology that's been running here.
CapTech has been running.
Yeah, it's still going. It's still working. And so, I don't know where it's going to go. I don't know where the next big jumps are going to come, but they'll start popping up into that list and the top of that list, and you can see things, as they're developing. And so, even though we were at red, we don't make wholesale changes until the market's going down. And then when we're below the 50-day moving average, is below the 200-day moving average, we get a red signal. We'll move, all the targets out and move into the whatever's at the top, which generally will be something more conservative.
Yeah, something defensive.
Yeah, T-bills, high dividend paying stocks, utilities, those types of things tend to be at the top in those environments. So we're trying to protect assets at that point in time. So what we were doing last year, right? So two different systems, and we've, from our back testing, we found that this is the optimal way to go. And we've had a really great run, in my opinion, on the stock market side of our equation since early May, and pretty happy with that. So now that we also had a change in the bond market signals. And so bond market is now green. It was red, now it's green-red. And so slowly but surely we're starting to see some stability in the bond market. And really, this has a lot to do with what's happening with inflation, what the Federal Reserve is saying, and those types of things. And so, what's fascinating is that if you look at the projections, so if we go here, this is the tool, the CME group does this Fed Watch tool. Yeah. And this is the futures market. And so Jay Powell today was speaking from Jackson Hole. Again, market is expecting the possibility of a big drop. As a matter of fact, it dropped yesterday 1.35% on the S&P 500 in anticipation of today's speech. And lo and behold, you have the speech. Well, last year he had a speech. It was down 3%. It kicked off the downturn. And so again, expectation very high that maybe we'll have the same thing because he can be very aggressive. He doesn't have to take questions during this period, during the speech. And so, there's no way to really soften it or clarify. He can just boom, boom, boom. And we did see some changes. So this was at almost 90% probability that we would have no rate increase in the next meeting in September. And now it's dropped down to 80%. So it's still high probability that there's no rate increase in September. However, if we just go and we look at November now, November, again, we're missing a month here. They only do 10 meetings a year, so we're seeing those gaps here. But they've got a rate increase of a quarter point, barely. It's what, 46% versus 42. But that just changed today, based on this conversation that the Fed chairman had. So, if you look then past that, you can go all the way out, to I think next December in terms of the projections on the futures markets. It's actually predicting rate cuts next year, right? And that's a good thing for bonds. And so again, the markets are looking forward. They're forward-looking mechanisms. The S&P 500 is part of the leading economic indicator basket. There's only 10 indicators in there. It's one of them. The markets are looking forward. So when rates start to come down, what's that usually mean?
Rates come down, bond prices go up.
Yeah, and what's usually happening economically?
Probably falling into a recession or some sort of slowdown.
Yeah, some kind of slowdown. Maybe a job market slowdown, because that's the Fed's other mandate, is to keep full employment, right? And so now, and a lot of people say, wow, we're in this recession, and the stock market's going to fall apart. Sometimes it depends, on what happens. I've seen an awful lot of recessions where the market does very well, mainly because it's already looking forward to the next. We're in recession now. The next one is, a economic expansion. Right?
Yeah, and the slowdown for the U.S. economy could be just a decrease in job postings. It doesn't have to be a major unemployment wave.
Yeah, exactly. So far, Chairman Powell, goodness, back in March of last year when they first started raising rates, talked about he sees the possibility for a soft landing, the Goldilocks zone, whatever you want to call it, for the economy because the job market was so strong. And he's been dead on right, even in the face of his other economists. There's over 400 economists at the Fed. As a consensus, they were projecting, a pretty good sized recession here this first half of this year. That didn't happen. Then they talked about the second half of this year, and now they've taken it off the table if you look at the reports. But the chairman himself was talking about this possibility of a soft landing and what he saw, and he's been right so far. I mean, it's been a year and a quarter since that started. So we'll see, and that's why just watch the stock market. Right? If we go back and look at what was going on with the S&P 500, it bottomed out in October and climbed that wall of worry. And the stock market's been correct, right? The reports that are coming out, they're not spectacular, but they're pretty good, especially considering what was expected on the negative, right? And so, we're fully invested. However, we do have new money coming in all the time. And we're sitting on that new money right now. I'd like to see 2 up days in a row. That's always been a key for me. We haven't had that. So today's up, right? So far, at least, during the show here, before we got in the show, it was up almost 0.8% on the S&P 500. We'll see where it ends up. But nonetheless, we've got this situation where, Monday hopefully will be up, but we haven't had that so far. We'll get that up day, and then the next day's down. And so, we're in a period where people are taking some profits. That makes sense. I mean, some of these companies like NVIDIA have had unbelievable years. And even the NASDAQ QQQs, the NASDAQ 100 is up, a huge amount for half a year period. There's no way that these things continue in a normal market. And so I do think that the AI component of the market is still going to be a driver. You can see it at NVIDIA's report. Their earnings and revenues were fantastic. A little hard to invest in it because a lot of the companies are small. This reminds me a little bit of the dot-com surge back in 95, so 5 years before it really crested. And the big companies were running at first, the Cisco's, the Sun Microsystems, and the companies that were seen as, you know, the internet providers, so to speak. Cisco wasn't a big company at that time per se, but, you know, similar to NVIDIA in that it's a provider. And then eventually you ended up with bingo.com and, you know, some of these crazy things.
The general stores and the gold rush, the ones that are giving out the tools for the miners, those are the ones that are running right now. Before the actual miners are the ones that strike it rich.
So I wouldn't be surprised to see that kind of unfold again, because this seems similar. There's a lot of hype about it. You know, we've shown that cycle a few times. So this is the hype cycle. I think that can be a driver that can continue to drive us back to a new high on the S&P 500 at some point in time. So anyway, that's what's going on right now. That's what we see. Really, you know, appreciate everybody, you know, watching through the summary, and we'll put that out as a separate video also. So looking forward to being able to talk about this again next week.